Welcome to ValueVest Daily. Today, we are diving into one of the biggest stories in the pharmaceutical world, maybe even the entire market. Eli Lilly just got the green light from the FDA for a daily pill that's shown it can help people lose over 12% of their body weight. Now, this isn't just another product launch, folks. This is a potential earthquake for the industry. The stock, of course, has already jumped, and you can bet Wall Street is watching like a hawk. But our job here is to look past that initial hype. We're going to do a real deep dive to figure out if this approval truly makes Eli Lilly a rock-solid long-term investment, or if the market is just getting a little ahead of itself. We'll look at the science, the business strategy, and of course, the numbers. Let's get into it. So all this news really boils down to one critical question for any serious long-term investor. Is this the moment? Is this when Eli Lilly goes from being just a big player to becoming the undisputed pharma giant for the next decade? And look, answering that isn't as simple as just looking at the stock price. It means we've got to go deeper. We need to really understand the science, unpack what the financials are telling us, get a handle on the competition, and be really honest about the risks. Only then can we figure out if this is a true compounding machine or just a classic case of market hype. So to get our arms around this whole thing, we've broken our analysis down into 5 key parts. First, we'll start with the catalyst itself, that big news from the FDA. Then we're going to zoom out and look at how this one little pill could totally revolutionize the entire weight loss industry. After that, it's time to follow the money and dig into Lilly's financials. And super important, we'll spend some time looking at the other side of the coin, the risks. And then we'll tie it all together with our final investment verdict. Okay, now before we jump into the really good stuff, just a quick and important reminder. This is all for educational and informational purposes. It is not, I repeat, not financial or tax advice. You've got to do your own homework and talk to a pro before you make any investment decisions. All right, let's do this. All right, let's get right into section 1, the FDA's big news. Now, to really get the impact of this, you have to understand that a moment like this is the finish line of a marathon that took years of research and billions with a B of dollars in investment. This isn't just a minor update. This is a landmark event that basically redrew the map for the entire pharma sector overnight. So let's break down exactly what happened. The big day was April 1st, 2026. That's when the FDA officially approved Foundayo. That's the brand name for the drug or forgliprin. And the approval is for chronic weight management, which is, a massive market. The market's reaction was, well, immediate. The stock popped about 4.5%, closing up near $960 a share. Now, for a company pushing a $1 trillion market cap, a move like that adds tens of billions in value in one day. But honestly, the number that really tells the story is the volume. The trading volume literally doubled. That isn't just everyday investors getting excited. That means the big institutions, the pension funds, the mutual funds, the real heavy hitters were buying in and buying in aggressively. They weren't waiting around. That's a huge stamp of approval, signaling that they believe this news fundamentally changes Lilly's long-term earning power. So, to really get why this is such a big deal, we need to talk a little bit of science. Don't worry, I'll make it simple. Foundayo is part of a class of drugs called GLP-1 receptor agonists. Sounds complicated, right? But the idea behind it is actually pretty elegant. See, your body naturally releases a hormone called GLP-1 after you eat. You can think of it as your body's built-in, hey, I'm full signal. It does 3 main things. It tells your pancreas to release insulin to manage blood sugar. It slows down how fast your stomach empties so you feel full longer. And it works on your brain to just produce your appetite. The genius of these new drugs is that they mimic that natural hormone, but they're engineered to last for a whole day instead of just a few minutes. So Lilly is essentially just turning up the volume on your body's own natural weight management system. And this is where the science meets some seriously brilliant business strategy. See, Lilly isn't starting from zero here. They already have an absolute blockbuster drug on the market, an injectable called Zepbound. But here's the catch. A huge part of the potential market, maybe 30 or 40% of people, are just needle averse. They just don't want to or can't stick with a weekly injection. Foundayo, being a simple once-a-day pill, is designed to go right after that massive, untapped part of the market. And what's more, there are no major food or water restrictions, which makes it even easier to take than some other pills out there. This isn't just a new product. It's a strategic move to bring millions of new customers into the Eli Lilly family. Of course, all the convenience in the world doesn't matter if the drug doesn't work. And this number right here, 12.4%, this is the data that really got Wall Street buzzing. That was the average body weight loss they saw in the big phase 3 trials. To put that in perspective, for someone who weighs 200 pounds, that's a loss of almost 25 pounds. That's a huge deal for doctors and regulators, and it puts this pill right up there with many of the injectable drugs. Now, is it quite as high as their top-tier injectable, Zepbound? No, that can get you over 20%. But that's the genius of the strategy. They now have a good, better, best lineup. Founjardio offers a fantastic result with maximum convenience. It's a 1-2 punch that makes them incredibly tough to compete with.
So let's move on to our second section, because this is where a great product meets a once-in-a-generation market opportunity. And the scale of this is, well, it's hard to overstate.
Okay, let's talk about the size of the prize here, because these numbers are just staggering. Right now, the GLP-1 market is already worth about $30 billion a year. But look at the projection, a 5-fold explosion to $150 billion by 2030. Let me just put that in perspective for you. That's an average of $20 billion in new growth every single year. A $150 billion market would make this one category of drugs bigger than the entire global market for cancer treatments is today. We are literally watching the birth of what's probably going to be the biggest pharma market in history. I love this quote because it perfectly nails Lilly's strategy. It's not about the pill replacing the injection. It's about making their whole ecosystem bigger. Think about it. When Apple launched AirPods, it didn't hurt iPhone sales, right? It leveraged the huge base of iPhone users to create a brand new, massive business. That's exactly what Lilly's doing here. Maybe a patient starts with the Zepbound injection, hits their weight goal, and then switches to the Founjardio pill to maintain it. Or maybe someone who hates needles starts with the pill from day one. By having the best-in-class options for both, they create this really sticky ecosystem that keeps patients and doctors inside the Lilly universe. Now, for us long-term investors, this all comes down to one key idea: the competitive moat. What are the durable advantages that protect a company? And as you can see here, Lilly's moat is becoming incredibly deep and wide. Let's run through it. First, that dual platform dominance we just talked about. They've got both ends of the market covered. Second, manufacturing scale. Lilly has already poured over $10 billion into new factories. A competitor can't just snap their fingers and do that. It's a huge head start. Third, we talked about how they're expanding their total addressable market, or TAM. And finally, and this might be the most important part, patent protection. The patents on these drugs run well into the 2030s. That gives them a legal monopoly and a very long runway of high-profit sales. So we've got the science and the strategy down. Now, for Section 3, let's do what we do best. Let's follow the money and see what makes Lilly such a financial beast. All right, let's get into the hard numbers that make this whole thing work. First, check out their current GLP-1 run rate. That just means based on their current sales, their existing drugs are already on track to bring in over $10 billion a year. That's the foundation. Now, on top of that, you add the projections for Founjardio. The street thinks this new pill alone will add another $5 to $8 billion in new revenue by 2028. That leads to their total company guidance of around $80 to $83 billion for 2026. But the number that should really get investors excited is that last one, a projected compound annual growth rate, or CAGR, of over 25%. It is just incredibly rare for a company this massive to grow that fast year after year. That's what sets it apart. Of course, a growth story this good does not go unnoticed. And that brings us to the big debate when it comes to investing in Lilly right now: its valuation. The stock is trading at a forward price-to-earnings ratio of about 45. Now, for context, the average for the S&P 500 is usually closer to 20. So yeah, on the surface, the stock looks expensive. A traditional value investor might see a 45 PE and just walk away. But as we know, a PE ratio without the context of growth is pretty much useless. So the big question is, can that valuation be justified? Well, one way to look at it is using something called the PEG ratio. That stands for price/earnings to growth. It's a super useful little metric. You just take that high PE ratio and you divide it by the company's expected growth rate. A PEG ratio around 1 is often considered pretty fair. So with Lilly's PE of 45 and its growth rate of over 25%, you get a PEG ratio of about 1.8. Now, while that's not dirt cheap, a PEG under 2 for a dominant company with a deep moat like this is considered pretty reasonable by a lot of people. It's a classic GARP stock, growth at a reasonable price. Yeah, you're paying a premium, but you're getting some of the best, most predictable growth on the entire market in return.
And hey, this isn't just our take. Just look at the sentiment on Wall Street. A full 90% of the professional analysts who cover Eli Lilly have a buy rating on it. You just don't see that kind of consensus very often. It's a pretty clear sign that the big-time analysts who study this company for a living are believers in the growth story we've been talking about.
And that bullishness is baked right into their price targets. The average target right now is sitting around $1,100 a share. From its current price, that suggests a potential upside of about 15% over the next year. And remember, those targets are usually looking out just 12 or 18 months. As long-term investors, we need to think bigger than that, and we also need to consider the risks.
Okay, no investment analysis is complete without a hard look at what could go wrong. It's easy to get excited, but we have to be responsible. So in our fourth section, let's take a balanced view and really dig into the potential headwinds facing Eli Lilly.
So what could derail this train? First, like we said, that premium valuation. When a stock is priced for perfection, any little hiccup, like a minor earnings miss, can cause a big drop. Second, side effects. Things like nausea are pretty common, and if too many people stop taking the drug because of them, that could hurt sales. Third, insurance companies. These drugs are expensive, and you can bet that insurers are going to push back on pricing. That's a real risk. Fourth, you can't forget about the competition. Novo Nordisk is a beast, and they've got their own pipeline of drugs that are going to fight for every scrap of market share. And finally, there's simple execution risk. Making enough of a drug that this many people want is a monumental task. Any little problem in the supply chain could be a major headache. And all of those risks really bring us back to the number one concern any value-conscious investor should have right now. Is the price just too high? Has all the good news been baked into the stock price already, leaving us holding all the risk with not much potential reward left? It's the most important question we can ask. So after weighing all those very real risks against this incredible growth story, our analysis leads us to believe that the bull case is still stronger. And why is that? It comes down to one overwhelming factor: the absolutely massive global demand for these treatments. This acts as a powerful tailwind that should be strong enough to push through those headwinds. The market is just so big and the medical need is so urgent that even with competition and pricing pressure, there should be more than enough room for Lilly to grow its earnings for years to come. Okay, let's bring it all home. In our fifth and final section, we're going to distill all this analysis down into one clear, final takeaway: the investment verdict. So let's boil this entire deep dive down to the final investment thesis, which really comes down to these 4 steps. It all starts with the catalyst. That FDA approval was a true game changer. That catalyst then helps to widen the company's competitive moat, giving them dominance in both the pill and injectable markets. That dominant position then fuels incredible growth, with that projected 25+% annual growth rate driving some serious compounding power. And all of that leads us to our final verdict. Eli Lilly looks like a compelling case to be a core, long-term holding for investors who want that rare mix of explosive growth at a reasonable price. So what's the actionable takeaway from all this? Well, while the long-term story looks fantastic, that high valuation means a little patience could pay off. The recommendation here is to view the stock as a strong buy on any kind of pullback, maybe in the 5 to 10% range. A dip like that would just give you a much better entry point and a greater margin of safety. And if you're looking out over the next 4 or 5 years, and if Lilly pulls this off, the analysis suggests the stock could potentially double or even triple from where it is today. So that leaves the final question to you. Based on everything we've looked at today, what's your game plan? Are you thinking about jumping in at today's prices, riding that momentum, or are you a little more cautious and you're going to wait for a pullback to get a better price? What an incredible story of science, business, and finance all coming together. If you found this deep dive valuable, do us a huge favor and please subscribe, like, and share ValueVest Daily. It helps us bring you these learning opportunities every single day before you put your money to work. And one last thing, we want to know what you're thinking about. Please drop a comment below and let us know if there's a specific high-risk, high-reward opportunity that you want us to tackle next. Thanks for tuning in, and we'll see you on the next one.